The global financial landscape is currently screaming for caution. We are witnessing an unprecedented market overextension, where traditional metrics of value are being stretched to their absolute breaking point. Retail exuberance has reached a fever pitch, creating a dangerous vacuum beneath the current price action. In this era of extreme volatility, survival is not just about catching the next green candle, it is about strategic preservation. As we analyze the heat maps and liquidity flows, it becomes clear that a massive correction is not a matter of if, but when. Today, we are dissecting a professional-grade defensive blueprint designed to navigate this storm, ensuring your capital remains intact while others succumb to the inevitable market gravity and catastrophic.
Enter the shield. Amidst this chaos, your primary defensive asset is the 14,129 USDT currently deployed within the Pionex Arbitrage bot. While the broader market swings wildly, this specific allocation acts as your safe harbor. The beauty of this strategy lies in its indifference to market direction. By utilizing a delta-neutral approach, you are effectively harvesting the funding rates paid by aggressive speculators who are over-leveraged in the futures market. This isn't about chasing moonshots, it is about the disciplined accumulation of yield in a risk-off environment. Keeping this capital locked in the arbitrage bot ensures that your core portfolio foundation remains immovable, regardless of how much blood.
Understanding how the Pionex Arbitrage bot functions is crucial for maintaining confidence during turbulent times. It operates by simultaneously holding a spot position and a corresponding short position in the futures market. This setup captures the funding fee every 8 hours, which historically spikes when the market is overextended and traders are desperate to maintain long positions. This $14,000 anchor is generating passive income from the very volatility that is destroying other portfolios. By maintaining this position, you are essentially the casino, not the gambler. As long as the market remains in this frenetic state, your arbitrage shield will continue to compound, providing a steady stream of liquidity. While the shield protects your base, the professional investor always looks for a tactical pivot to generate yield. Defensive positioning does not mean total inactivity. It means waiting for the precise moment when the risk-to-reward ratio tilts heavily in your favor. We are now shifting our gaze toward the Asian markets, specifically the Singaporean financial sector, which offers a unique blend of stability and high-quality income. This transition requires a keen eye for technical levels and a deep understanding of corporate timelines. By utilizing your idle buying power on Moomoo, you are preparing to strike at a specific structural inefficiency that occurs only a few times a year. Let us focus on the 9,100 buying power currently sitting in your Moomoo account. This capital is earmarked for one of the most reliable blue-chip moves in the Southeast Asian region, DBS Bank, ticker D05.SG. DBS is not just a bank, it is the financial backbone of a global trade hub, known for its robust balance sheet and consistent dividend payouts. In a world of uncertainty, DBS represents a pillar of fiscal strength. We've been monitoring this asset for weeks, waiting for the perfect technical alignment. The current market conditions have created a rare opening to acquire this high-yield giant at a price that reflects fundamental value rather than speculative froth. It is the cornerstone of our.
Today is May 11, a critical date in the DBS calendar. It is the ex-dividend date, a moment of technical transition that often confuses the retail crowd but offers a massive opportunity for the disciplined. When a stock goes ex-dividend, its price naturally adjusts downward to reflect the payout of the dividend to existing shareholders. This is not a sign of weakness, it is a mathematical certainty. By understanding this mechanic, we can ignore the superficial red on the screen and recognize it as a strategic entry window. The market often overreacts to this drop, providing a momentary dip that allows us to step in and secure a long-term position at a significantly lower cost base. The target level for your DBS entry is precisely $58. This technical drop, triggered by the ex-dividend adjustment, represents your most worthy income entry today. At this price point, you are not just buying a stock, you are purchasing a cash flow machine at a significant discount. The 9,100 buying power is perfectly sized to build a meaningful position here. If the market dips to 58, the dividend yield becomes incredibly attractive,
offering a margin of safety that is virtually non-existent in the overextended US tech sectors. This move is about securing income energy. You are placing your capital where it is respected and rewarded, far away from the speculative bubbles that are currently threatening the global indices right now.
However, no portfolio is complete without considering the macroeconomic threats looming on the horizon. The ongoing shipping crisis is no longer a footnote. It is a primary driver of inflationary pressure and supply chain disruption. From the Suez Canal to the Red Sea, the arteries of global trade are being constricted. This creates a ripple effect that eventually hits the tech-heavy QQQ as higher logistics costs and component delays erode the margins of Silicon Valley giants. We are watching the shipping indices closely because they act as a leading indicator for the next leg of the market's move. If these bottlenecks continue to tighten, the overextended valuations of the Nasdaq will be forced to reconcile with the harsh reality.
This is where the oil hedge comes into play. We are monitoring the Micro WTI crude oil futures, specifically the MCL contract, for a potential breakout. If oil breaks above $95.50, it signals a major shift in the inflationary landscape. Higher oil prices act as a tax on the global economy, further straining the already fragile shipping networks. By keeping a close eye on this $95.50 level, you are identifying the point of no return. Using the MCL setup allows for granular risk management, providing a hedge that gains value as the broader market feels the pain of rising energy costs. This is your insurance policy, a necessary component for any professional-grade portfolio in today's volatile climate.
The relationship between oil and the QQQ is often inverse during periods of supply-driven inflation. As the cost of energy rises, the discounted cash flow models for high-growth tech companies begin to deteriorate. The shipping crisis acts as the catalyst, pushing oil prices higher and forcing the Nasdaq to reevaluate its lofty price-to-earnings multiples. If oil sustains a move above our $95.50 threshold, it will likely be the final blow that forces the QQQ down toward our critical $634 level. By holding the MCL hedge, you are effectively shorting the macroeconomic stress. You are turning the very factors that threaten your long-term tech holdings into a source of short-term profit, creating a true...
Let's talk about that $634 level on the QQQ. This is your line in the sand. In an overextended market, technical supports often fail, but this level represents a historical zone of high-volume interest. If the shipping crisis and oil surge force a correction, this is the destination where we expect to find a floor. Having your 14,000 USDT safe in the arbitrage bot and your DBS income position secured allows you to watch this potential drop with total composure. You aren't panicking because you've already prepared your insurance. If the QQQ touches 634, you will be one of the few investors with the liquidity and the psychological clarity to make rational decisions, while others...
To summarize today's master blueprint, maintain the shield by keeping your 14,129 USDT in the Pionex Arbitrage bot to harvest low-risk yield. Utilize your $9,100 Moomoo Buying Power to enter DBS at the $58 level today, capitalizing on the ex-dividend price adjustment for maximum income potential. Finally, watch the Micro WTI oil price for a break above $95.50. This is your insurance against the shipping crisis that could drag the QQQ down to 634. This three-pronged strategy ensures capital preservation, income generation, and macro protection. By following this disciplined path, you are